Hello and welcome to Fidelity Connect's podcast. My name is Jordan Chevalier. I'm a communications manager here at Fidelity Investments Canada. Today we're joined by institutional portfolio manager Ilan Kolet. Ilan is a member of Fidelity's Global Asset Allocation team, the GAA team for short. They put out these really interesting quarterly thought leadership papers. The Q1 2024 paper, 11 questions for 2024. It's live now. It's on fidelity.ca. Ilan is joining us here on Fidelity Connects to talk about the paper. So welcome, Ilan, and thanks for joining.
Yeah, thanks very much, Jordan. Looking forward to our discussion today.
Yeah, absolutely. And I think right here off the top, let's get into a little bit about what the GAA team does. I know from reading the paper, it's yourself and David Talk and David Wolf. They have put this paper together. You guys all do it once a quarter. So give a little bit more background into what the GAA team is, what the mandate is and what that paper hopes to achieve.
Sure. So, our job on our team is really twofold. We manage all of the multi-asset class solutions for Canadian investors. And there are really two ingredients to that. The first is we have to pick the managers that we want to use in our funds, right? So no managers are forced upon us. We choose the best in class managers from across Fidelity in Canada, the US, and internationally, and combine them in such a way to create really balanced exposures for every type of investor. And then the second part of the process is using our 4-pillar investment process to lean in or out of asset classes, currencies, geographies, styles, sectors, all with a view, with both of those ingredients, of adding return in excess of our benchmark, right? That's the end goal, is add return over and above our benchmark while always thinking about risk and portfolio risk as well. And so what we do, as you mentioned, Jordan, is every quarter we write a paper. And I think what has now become a bit of a tradition is Q1, we use an FAQ format and really answer those top of mind questions, that investors and advisors have from coast to coast.
Incredible. And so this quarter, it's 11 questions. And I think of those 11, looking through, if I were to pick a big one that I think, if we were to do an FAQ of advisors and investors, inflation is top of everyone's mind. And you mentioned in the paper that things have cooled a little bit, both in the US and in Canada. I think advisors and investors, they're feeling that a little bit, but for the rest of 2024, so the rest of the year, right? I think the back half of 2023, we saw the cool. And now where do you see that going in 2024? You touch on it a bit in the paper, but.
Yeah, so, I spent decades thinking about inflation, both in the US and in Canada. And, we can't ignore that we have seen meaningful progress in both the US and in Canada on both total inflation and underlying core inflation, right? Core is that measure of inflation that strips out generally food and energy, or the more volatile components. And we have seen progress towards more normal levels that central banks want to see. But in our view, it's a little bit premature to say that the fight has been won, right? The battle has been won. Again, we've seen the transitory elements of inflation, which went much higher during the pandemic, right? Specifically goods prices, because of supply chain shortages and none of us being allowed to actually purchase any of the services like recreation or travel. The goods prices pushed much higher. Goods prices are now inflating at basically pre-COVID rates. And so the goods price shock has been removed from the consideration or calculation, basically. But what we're left with now are service prices, which are still elevated, uncomfortably elevated for where central banks would like inflation. And the reason that matters is services account for roughly 3/4 of the underlying core inflation basket, number one. And number two, service inflation is very closely linked to underlying labor market pressure, right? So when the labor market is exceptionally tight, which in English, when the unemployment rate is very low, wage growth normally outpaces, pushes higher. And when wage growth pushes higher, the services that are based on those wages push higher as well. And that's the situation we're in right now. Again, there has been some progress even on the services side, but there are stickier elements of that services bucket that remain uncomfortably elevated. And that has important implications for how central banks are thinking about the path of rates.
No, that's very helpful. And I think that really paints the picture for the rest of 24, that those are the key things that you and your team are looking at. And so it's really, I think what you're saying is it's too early to tell right now how the rest of the year will go. We need to wait for, maybe, I think you talk in the paper about some CPI data coming out, and you have to track there. What specifically are you looking at within that CPI data?
So again, I mean, when I used to sit on the research team in Boston, I was the head of inflation and commodities research. I had a dashboard that had dozens and dozens of ways to slice up the inflation prints just for the U.S. Right? So there are an infinite number of ways of looking at inflation over various horizons. Generally, when we read about inflation, right, in the newspaper or on our Bloomberg screens, we're looking at the rate of change in the price from today versus 12 months ago. But you have to remember, 11 months of those 12 months are stale data, right? And so that's not giving you the most vivid picture of the dynamics in inflation. What I like to look at is shorter term horizons, right? So the 3 and even 6 month annualized measures of core inflation, again, both of which in Canada and the US have moved much lower. But there are still some elements where we think the labor market needs to adjust and needs to cool, which may already actually be happening in order for wages to slow and then services to slow. So my sense is, in terms of what I'm actually looking at, I still look every month at the very detailed disaggregation of inflation, both in Canada and the US. We get hundreds of lines of data. And I look at those really sticky elements. So shelter, for example, in the US is a very, very important determinant of the underlying path of inflation. It's very slow moving, and it's very, very linked to conditions in the labor market. And again, the reason this is so important is it informs our view on the path of rates from the Bank of Canada and the Federal Reserve, which again will inform positioning across our multi-asset class funds.
That's great. And I'm glad you mentioned that, because the next question, and I think you want to talk more about, we want to talk more about that overall asset allocation. So how has that in 2024, if you're an investor or an advisor and you want to know, okay, we know that, inflation's cooled, we're looking at the CPI data, but how is that informing, or how has it informed those decisions on your team with you guys looking ahead to 2024?
Right. So, I mean, if I use the managed portfolios, these are the flagship tactical portfolios that many advisors and investors will be familiar with. As an example, one of the real advantages of those funds is they are tactical, and positions do evolve over time, right? And so take for example inflation. In 2022, which seems like a lifetime ago now, we had a considerable amount of inflation protection in the form of overweights to commodities and inflation protected debt. Those positions have come down, but they still remain in place as overweights in the portfolios that we manage, but just smaller than they would have been when inflation was a very, very heightened concern. So with the evolution of data and the improvement in inflation, we take that on as well in the context of our portfolios. And right now, those portfolios, there are defensive positions baked into those portfolios, say around our concern in Canada. But then there are also opportunistic overweights in the US and emerging markets and elsewhere, where we think we can enhance the return profile of those portfolios. On net right now, let me think, as of the end of November, the 60-40 portfolio, the global balance portfolio, is sitting very close to 60 and 40. Again, those positions have evolved as the year ended and into the new year. But we're sitting very, very close to the 60 and the 40. But there are opportunities for us to be defensive around areas where we're concerned, and again, be more optimistic. For example, in the U.S., where we think the likelihood of a soft landing has materially increased.
No, and that's great. And I think that's one of the questions, right? Is that you're touching on that soft landing. You think that there is a decreased chance in the US. For Canadian listeners and for our Canadian advisors and investors, what's one thing you think that they can be optimistic about sort of in the middle half and latter half of the year this year?
So I think one of the things I'm most optimistic about, so optimistic I can barely get the words out here, is I think the likelihood of the US sticking a soft landing has materially increased, right? This is something I spoke with thousands of advisors about all through last year, and we'll continue that discussion this year. But it's not impossible in our view that there has been a meaningful push higher in potential growth in the US, say because of artificial intelligence, investments in clean technology, more flexible work arrangements. All of those things may have actually increased the productive and potential capacity of the US. If that's the case, it's a wonderful story, really, for equities, for inflation, for growth, for earnings. And for the investors and advisors on the call, those are the topics we're thinking about. And those are some of the things that inform our overweight to US equities, right? So even though I'm talking to Canadian advisors and investors right now, I mean, the benefit of a fund like Global Balance, Global Growth, these are globally diversified funds that can take advantage of some of those opportunities not in Canada. And then again, with our more cautious view on Canada, which we also get into in that paper, that's where we think we want to be a little bit more cautious, and where there might be some underperformance versus, for example, the US. So that's what I'm excited about. And then I would say, if I had to add one more thing, I think as we get further and further away from that COVID shock, the sense of normalization really starts to enter sort of life and markets, right? And that, a return to a more normal investing environment, right? That death of 60-40 that everyone was talking about in 2022 certainly got shrugged off in 2023.
I think that's extremely helpful to Canadian advisors and investors and everyone listening. We'll wrap it there. The paper is now live on fidelity.ca. So you go to fidelity.ca, there's a market insight section. If you follow that link, you'll see 11 questions for 2024 by Ilan and the rest of their GAA team. So Ilan, thanks so much for joining us. I hope you have an excellent rest of your day, and we'll see you again on the show soon.
Thanks, Jordan.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.